So now that the French embassy is there as well, I think I can start. Welcome. Welcome everyone. Here at the Hertie School, I'm Johannes Lindner. I'm co-director of the Jacques Delors Centre. It's a great pleasure to welcome you to a very topical theme for today, banking union, the completion of banking union. And it was in June 2012 at the European Summit when the leaders decided to create banking union. And then 2 years later, at the inauguration of the first pillar of the banking supervision, the first pillar of the banking union, banking supervision, Mario Draghi, one of the key players in the creation of the banking union, stated, "The setting up of the European banking supervision has been the largest step towards deeper integration since the creation of the economic and monetary union, one that provides a determined response to the crisis, strengthens the euro, and will protect us in the future." So these were the words of Mario Draghi 10 years later, after the creation of the first pillar of banking union. We want to look back and say, where do we stand on banking union? And I think we're doing this at the right time, at the right place, with the right people. Right time, because we are in a period where a new commission is looking for its agenda, it's defining its agenda. And we will have the hearing of, in particular, the commissioner responsible for the banking and financial services. And it will be very interesting to see what's her agenda for completing banking union. Right time also, because as you know, we are in a heated debate on the bid of UniCredit for Commerzbank. And some of the reaction of the government here in Berlin, the German government, including the chancellor, that was rather critical on this takeover, has in itself created some critical reaction in the rest of Europe, doubting whether there is a full commitment to completing banking union on the side of the German government. So I already mentioned Berlin. Berlin, I think, is the place that is probably also very relevant for the question of how and when we are completing banking union. And the right people, because we have two excellent panelists that are, to some extent, although they may not fully agree, represent also different positions on the spectrum. And I'm very, very glad to have Karolin Schriever here from the German Association of Saving Banks. And she's managing member of the board since 2022, after an apprenticeship at the saving banks and then university studies in Dortmund. She worked from 2006 to 2022 with KPMG, both in Frankfurt and in Luxembourg. And from 2017, she was the partner responsible for accounting, banking supervision, and sustainability. And then in 2022, you joined the Saving Banks Association. So a warm welcome to you here. And please take a seat. And then I'm glad to welcome the author of this booklet, which is, and there, you know, there's no free lunches, but there are free books. And so I'm very glad that Nicolas Verón is with us, the author of this book that goes back to the foundation. It really even goes beyond 2012. It also really looks in the run-up to the creation of the banking union and also presents a proposal on how to complete it. So Nicolas Verón is of course a well-known commentator to banking and financial services. He's a senior fellow at Bruegel, that in fact also he co-founded in 2002, and at the Peterson Institute for International Economics in Washington. He was one of the early advocates of banking union. And as I said, the author of the book that is available to you and that I can highly recommend. He has previously some experience in the private and public sector and is a graduate from École Polytechnique and École Nationale Supérieure des Mines in Paris. Now, I have asked Nicolas to say a few words at the beginning. Then I asked Karolin to also say a few words from her side so that we have two introductory inputs. And then we will have a conversation, just the three of us here on the podium. And then I'm very happy to open up. Now, we are here together, but we also have a number of colleagues that are watching it afterwards. So we're not live streamed, but we're certainly up in the air after this meeting. So that just to be aware that if you ask a question, you'll be recorded and will live on in eternity in the internet. So just to be aware. So with this, I hand over to Nicolas. The floor is yours, and we'll then take it over to Karolin.
Thank you so much, Johannes. You mentioned the people who are or will be watching without being in the room. It's impossible for me not to think of Henrik Enderlein being in this room. He was a friend. I admired him. His memory stays with us. Very kind introduction. You basically said, I think, everything I wanted to say about the book, so I can be extremely succinct. It's always a bad sign when somebody says that, but I'll try to abide by the discipline. The book was a labor of love, and is essentially three things. One is kind of the normal things that think tank people like me do. There is an analysis of a policy framework. There's an assessment of that policy framework. There are recommendations for next steps. In a way, it's from a certain perspective, the least interesting part. I think the book tries to do two other things, which maybe are more ambitious. One is to actually establish a record of events and debates, because I'm not aware that had been done before on this important topic of banking union, to bring together the long history, as you mentioned, starting in the 1970s, the first available mention of the idea of the vision of European banking supervision dates from 1973, so more than half a century ago. And the key moment of decision in 2012, which you mentioned. So establishing that record is something that struck me as potentially useful. And it's not the last version, because I'm sure, especially when archives are open about 2012, there will be more details emerging, which will be good. The other thing that the book tries to do, in a way, is more debatable. In a way, it's a celebration of a European achievement. And as the title indicates, this achievement is unfinished, but it's significant. And I often get the feeling that this particular achievement, maybe because it's about banks and everybody hates banks, except when they're Sparkassen, and the fact that it's a lot of abstract material. But I think it was a very significant policy achievement for the European Union, for European integration, for crisis management and resolution. I make the argument in the book that the decision to start banking union was central to resolving the Eurozone crisis. This is still a matter for debate, so I'm sure we will come back to it. But I think the EU achieved already a lot with banking union, and that deserves acknowledgement. So the structure of the book is very simple. It's very linear. There's an introduction, and there is a chapter about this long history which documents the fact that the debate about a European-level banking policy framework is very long-lasting. As I said, the first indications in the early 70s, and a lot of discussion in the run-up to Maastricht, including in the negotiation of the Maastricht Treaty itself, even so that was not necessarily what was most prominent in the commentary, and Maastricht didn't fully, create a banking union, but importantly, it provided the legal basis for it, and I tell that story. Then the third chapter is about this decision-making moment in 2012, and here I did a little bit of amateur journalism. I discovered that, I have the story that there was an important meeting at the Charles de Gaulle airport near Paris, where the core of the deal was made. But I spoke with a number of the people who were at that meeting, and they all told me very different stories. So I learned that, oral histories are tricky. I hope I got it correct. I'm not sure. The archive maybe will say in the future. The fourth chapter is about European banking supervision. I have a very positive assessment of what is also called the single supervisory mechanism so far. So the supervisory framework that is centered on the ECB involves national authorities such as the BaFin in Germany, and is in charge of licensing and supervising all banks in the Eurozone. So the assessment, it has been effective so far, but there are two caveats. One is so far, so the past is no guide to the future, and I think it remains to be seen whether the European Central Bank maintains the same level of supervisory effectiveness in the future compared to what they have achieved in the last 10 years. As Johannes mentioned, this is where there is a 10-year anniversary because this system entered into force in early November 2014. The second caveat is that supervision is not enough, and that was the discovery of the Eurozone crisis, that even with good supervision, you may still have crisis in the future, and if you don't have a good crisis management and resolution framework, and in that case, if you have, like we currently have, a kind of awkward halfway house of national and European elements of a crisis intervention framework, that can create a lot of problems in the future. Interestingly, the early debates about what is now called banking union, so the debates on the 70s, 80s, early 90s, they didn't really identify this, with very few exceptions. They thought that if we had European banking supervision, the problem would be resolved. So what we learned in the Eurozone crisis is that the problem is more difficult than these early visionaries, or at least most of them, had understood. So chapter 5 looks at those missing pieces. To me, they are essentially twofold. One is what I mentioned, the crisis intervention framework. The other one gets less attention in the public domain, even so it got equal attention in negotiations among member states, which didn't deliver anything in the last 10 years of discussion. It's the challenge of concentrated sovereign exposure. So here I'm going into a little bit of jargon. I hope that's okay, but most European banks most European banks hold a lot of sovereign debt. That's normal. This is a high-quality liquid asset, and actually the regulation encourages banks to have sovereign exposures. But the twist is that in the Eurozone, they tend to only hold, or to overwhelmingly hold, sovereign debt of their home country, and this is not something that is desirable from a financial stability perspective. Actually, the opposite is desirable. It would be much better if those banks had a diverse portfolio of Eurozone sovereign exposures instead of having this concentration in the home country. And this can sound like a very technical matter. It's actually highly political, because what is behind it is the fact that national governments in the Eurozone want to be able to leverage the national banking sector to help them finance the government with favorable conditions. So that's what economists typically call financial repression. And it is short-term advantageous for those governments, and in a sense, contributing on a very short-term basis to financial stability. But it is actually an element of moral hazard and lack of efficiency, but also bringing instability at a structural level to the financial system. So this challenge of concentrated sovereign exposures has been, as I mentioned, discussed in working groups, but not much in public. And I think it is essential to elevate it to a much more public level of discussion if we want to be able to complete the banking union. Maybe we'll come back to it in the discussion. And then the last chapter of the book is kind of forward-looking, suggesting that it would be better for the European Union to complete the banking union, to finish the job without waiting for a crisis, to force that completion to be executed. So be proactive, not succumb to the fatalism of low expectations, right? I mean, I know that many people, including in this town, but not only, say, oh yeah, it would be nice to complete the banking union, but it's politically difficult, so it won't happen, and forget about it. That's the wrong attitude. This is irresponsible. It is not statesman-like. Having said that, it is clear that completing the banking union is politically difficult, and we'll probably come back to that in the debate. And then in the same spirit, there is a bit of a sketch of what it would take in practice to complete the banking union. So create an integrated framework for crisis intervention, which would include, of course, a European deposit insurance, but would not be strictly limited to it, because there are other elements that are desirable for that matter. And conversely, introduce what is often referred to as sovereign concentration charges, so a regulatory instrument to address the challenge of concentrated sovereign exposures. None of that requires treaty change, none of that requires fiscal union, but still it's politically challenging. Let me just conclude by saying that what's happening around Commerzbank is a true test for banking union. In a way, it's a test of seriousness for policymakers, whether they believe what they say. I mean, policymakers in Germany, like in almost every Eurozone country, actually I think every Eurozone country in the last 10 years, they have been saying we're in favor of completing the banking union, but when a real world situation arrives of cross-border consolidation, things become much more challenging politically because there are special interests, in this case, for example, the unions, but others as well, and a more atmospheric element of economic nationalism. So I think this is a very timely discussion for that matter. It will be very revealing to understand the true state of the banking union project, to see how this particular transaction goes through or not. And with that, many thanks again, Johannes, for the invitation.
Yeah, welcome and hello. Thanks, Nicolas, for the book. I read it, and I must say it's very well written. But while not agreeing to everything that you said in your book, it provides a very interesting view on the banking union, especially when it comes to the description of the actual events that lead to the creation of the banking union. It was just for me, let's say, a little sad that the smaller and regional institutions like the Sparkassen in Germany or other countries like Spain, Italy or Poland are only played a role as an obstructive force that is blocking progress. But no word on the historical reason for the reason why we are, how we are, and that we are a network when it comes, and that is the important role we have, the stable supply of loans for the German SMEs, and when it comes to the reduction of regional disparities or financial inclusion. So better that very thank you that I was invited today to shed a little light on that, because that I find very important. And obviously, Nicolas, I will also explain why we don't need EDIS, but first let me take a step back. With the start of the new legislative circle, we are at the point in time again where it is possible to provide a broader perspective on what will be the essential task for the EU in the coming years. Take a look at the two most prominent commentators, Letta and Draghi, who both provided excellent reports, or the mission letter for the designated commissioner, Maria Luis. Our economy needs to become more competitive, and for this it needs adequate financing. That means tailor-made financial solutions. And that leads to tailor-made financial banking system. And for the banking sector, this translates furthermore into improving and simplifying the regulatory framework, as highlighted especially by the Draghi report that calls for an assessment of what is adequate for a strong and competitive banking system. So we need to protect the existing banking union we have, that is taking into account the national banking systems to avoiding disrupting those aspects that are already functioning very well. And looking at the past years, EU regulators and the entire banking industry have done their homework very well. And I would be a bit more positive on this than you, Nicolas. We have a comprehensive regulatory framework and a resilient banking sector in place. And we have a functioning banking union with a single supervisor, a single resolution board, and a single set of standards for all our depositors in Europe. All this has proven its worth in the past years during Corona, while banking sectors in the US and Switzerland witnesses quite some turmoil. EZB, EBA, SRB, and many more were all doing a very good job, and we recently saw that in terms of UniCredit and Commerzbank. So, what we do need after financial stability has been in the center of attention for the last 15 years. We need a stable banking sector that is also functioning at its best possible in order to help the bringing up 750 to 800 billion euro per year to close, and that is very important, and that is the main task for Europe, the Green Deal, to close the economic gap with China and the US. And here it is of huge importance for regulators to have in mind that banking union is home, and you mentioned it already, and I'm glad for that, Nicolas, to diversified banking sector with different structures, business models, clients, needs, and risks. The diversity is extremely beneficial for the economy and customers. It leads to a highly competitive banking market, tailor-made financial solutions, and it ensures systematic stability. And allow me, I want to compare Europe with a single company. So when companies decide on diverse teams and striving to increase workplace diversity, that is not just a slogan. It is a very good business decision because diverse teams are smarter and lead to better results. So why should a country do that differently than a company when it wants to be competitive against the US and China? But we need both. We need national and international champions taking higher risk and executing complex mergers, of course. And we need small, locally rooted institutions with quick lending decisions and high customer proximity. They are natural partners for SMEs and private households. And that is very important because the Commission is saying that transformation is the key to success. But for transformation, you need the people. You need to understand the people, and you need with the people, and you need quick and smart decisions. So, for our side, a major challenge for the banking union is to achieve the goals of an unrestricted single market, while at the same time allowing for competitive national subsystems. In other words, integration should not be pursued at the expense of a large share of the banking sector. The interests of small and medium-sized, regionally focused credit institutions and the special characteristics of their network organizations must not be disregarded. There is no need for artificially leveling entire national financial industries, as there are valid reasons for the differences in existing structures. Especially since they correspond to the underlying economic structures. In Germany, SMEs generate half of the value added and 60% of all employment and tax payments. Bank lending is their single most important source of finance. The background needs to be taken into account to understand why Germany can be considered to be the essential LSI country, as its roughly 1,350 LSIs make up 50% of the total number of LSIs in the SSM. As the center of the debate are the IPS, like ours, that get undermined in their ability to function. And just to be clear, this is not an outlier problem. More than 2,000 small, medium-sized EU banks are organized within the IPS. In Germany, Austria, Poland, Spain, and Italy. IPS protect their members' solvency and liquidity, which goes beyond the sole redemption function a traditional DGS has. And EU IPS represent almost 100 million customers and are now be threatened by two legislative proposals, the CMDI and EDIS. So the DSGV and many more will continue to oppose EDIS. At the very least, the interest of IPS must be adequately taken into account. And we will also continue to call for resolution to be considered necessary for institutions prudentially classified as systematically important. And the Eurogroup statement was, in terms of that, crystal clear. The CMDI review will have to preserve a functional framework for these IPS. And in the same vein, taking a look at Commissioner's letter, there is a call to have national values in mind when looking at ways on how to advance with EDIS. So let me conclude by stressing the need for our regulators to preserve the diversity of our banking sector, to be a smart and competitive Europe. It is very important that regulation starts to take into account the roles, business model, and risks of different financial institutions. When looking at the banking union, we should not continue to waste our energy on old discussions. Now it is, in our view, about addressing the concrete question of how to advance the banking union in a way allowing the entire banking sector to be part of the solution. United in diversity is not only the EU's official motto, but a desirable goal for European policy to achieve. And please think forward. AI and ESG will not stop at the German border. It will not stop at the European border. It will connect people in a complete new way. And that should be the focus of a banking union by tomorrow, to be smart, forward-looking, and therefore competitive. Thank you very much.
Thank you very much, Karolin. Thank you very much, Nicolas. So now we have 45 minutes, and I see myself very much as a facilitator between these two, but also between you and them. So we will have, I think, about a half an hour that we will spend here on the podium, a bit less, and then we'll open up to questions for you. Now, I will organize our conversation here, and I hope you don't mind, along three blocks. The first is very short, which is the current status quo, the current achievements, where I want to look at the first pillar, so under supervision, which both of you have touched upon, and I think want to speak on it very briefly only. The second one is then on challenges, and there we look at the two other pillars that both of you have mentioned. So the resolution pillar, and then the deposit insurance, the EDIS pillar. Coincidentally, of course, it doesn't help that the banking sector here in Germany is also three-pillared, but forget that for a moment and concentrate on the...
These are the real pillars.
These are the real pillars, you say? Okay, let's go back to that when we discuss then the last block, and the last block is the question of future vision, where we look into what should, I mean, very much along the lines what Karolin said, what should be the sort of future of the banking sector in Europe. So these are the three blocks. And I start with the first block, which is a bit the achievements. I sense a bit from the two of you that when it comes to supervision, the main achievement, namely financial stability, has been attained. And you are generally, with a combination of rules and supervision, you're generally content. Now, you mentioned, and here's the first acronym that was brought up, that not maybe everyone knows, and maybe not everyone likes, which is LSI. LSI is less significant institutions. Of course, the saving banks don't see themselves as less significant, but at the same time, this is just simply the two-tier system that we have in banking supervision. Now, maybe just a word on whether you agree with the overall description that the first pillar is working, and maybe just a word on whether the fact that most of the saving banks are in fact not directly supervised by the ECB, but in the structure that is different. Whether, I mean, just a word on how do you see that, and how the first pillar is working for you.
Yeah, that is a very good question, and thanks for explaining Ella's eyes. And I think the first pillar is working very well, and we see it. I think looking backward in the last 10, 15 years, we got through all the hiccups very, very well, and we saw the US struggling, we saw Switzerland struggling. We had a few discussions with the UK, who is struggling in a different way, but we were all very, very stable. And you can see it with the current, I mentioned it already, Commerzbank and UniCredit. You see that you don't need an EDIS to have a European mergers or anything else. So this is working very, very well. And we have, I think, a very, very well working system in terms of that, because our saving banks in the different regions, most of them are not supervised from the ECB, but over our network, that is in a very close touch with the ECB, and we just revised it last year. So this is now proven very strong, and I think very up to date for all the challenges that are ahead, and especially taking into account what happened in the last 10 to 15 years. And I think the network we have, so how, I mean, when you look, for example, the US has, I think, 3,000 regulations. In the same time, Europe has 13,500. How can, let me say, the Sparkasse Münsterland Ost, yeah, with 85 people, how can this bank handle all these pages of CRR and other regulations? They need a system that is helping in terms of IT, in terms of risk management and so on. And that is what we are doing, and this is why we have the national authority and also the EZB. And so we have already, let's say, a double protection and a double authority, which we are handling for a very long time now, and we want to keep that working. We don't want to give that up, because then you would take away a very well working system, and you would make a lot of people struggling who are financed by that kind of banks.
Thank you very much. Nicolas, maybe I can combine the same question with an additional question. So you mentioned that for a while there was the perception, and particularly before the financial crisis, that good supervision may be enough. So we have good supervision now, it seems, and also you write that in the book. But why is it not enough? Why is what you call the sort of half-finished resolution framework a problem? And where would you say are further improvements needed? First on supervision, if any, but in particular on the second pillar.
Yeah, first I have to commend Karolin for her constructive engagement with the supervisory system as she described it. To me, there's a lesson here, which is that policy integration at the EU level is not a threat to national specificities, and that's true of supervision. I will make the argument that it's equally true of crisis management and deposit insurance. And indeed, when the single supervisory mechanism was established, there were, perhaps justified, I don't know, but there were a lot of fears, concerns, oppositions in the German Sparkassen environment against this very concept of a single supervisory mechanism, and arguments that it would be dangerous for the diversity of the European banking sector. 10 years later, as you correctly described it, those concerns have been proven to have been excessive or actually misplaced. I would extend that to our debate about crisis management and deposit insurance. I think it's perfectly possible and indeed desirable to create a European crisis intervention framework that would be entirely compatible with the kind of beneficial diversity of banking structures that we're observing in the EU. Why is supervision not enough? It depends on your risk appetite or risk perceptions. If supervision is uniformly effective, banking crisis may become infrequent and of low magnitude. Now, you can make an argument that a supervisor that is too risk-averse may be harmful to the economy, would decrease the frequency of banking failures, but to the price of economic efficiency. I have problems with that argument, but it's out there. Let's park it aside. I think a more substantial point is that no matter how good a banking supervisor, there will probably be banking crisis in the future. And if only for exogenous reasons. Karolin said there was a good, the COVID crisis showed that the banking sector was sound. I would qualify that assessment because I think the banking sector would have struggled without the massive fiscal intervention that came with the COVID crisis. And indeed, that fiscal intervention had to come partly from the European level, in large part from the European level through Next Generation EU, precisely because of the banking sector. Some of you probably remember those weeks of March, April, early May 2020, when the concern was that the shock, the exogenous shock of the lockdown, would reignite the bank sovereign vicious circle and lead to financial fragmentation in the Eurozone that might even threaten us with the breakup of the Eurozone. The response to that was Next Generation EU. It worked very well, but what it demonstrated is that you still have to worry about financial crisis and financial stability, even in the presence of strong supervision. Back to the banking union agenda, the definition of banking union as it was drafted by the leaders of the Eurozone in the early hours of June 29, 2012, when banking union was started, was we affirm, that the leaders speaking, that it is imperative to break the vicious circle between banks and sovereigns. That's their statement. I believe it's a correct description of what this project is about. And if you take that description literally, the job is not finished. The banking sector remains joined at the hip with national creditworthiness, sovereign creditworthiness. This is manifested in sovereign exposures, and this is manifested in crisis intervention frameworks that are directly and indirectly reliant on national budgets and therefore national creditworthiness. So if you want to have a functioning banking union that ensures real resilience of the Eurozone, not just in normal times, but in times of crisis, which will come back one way or another, including the experience of COVID, you need to finish the job, you need to break the bank sovereign nexus, you need a European deposit insurance and crisis intervention framework, and you also need to tackle concentrated sovereign exposures. So it is normal that after 10 years of basically no crisis, complacency sets in, and people start saying, you know, why finish the job? It's painful. Let's stay with the status quo. It works. This is completely understandable and predictable. That doesn't mean it's sound policy advice.
Maybe I can add to what Nicolas said. So we do have the resolution pillar, but we don't have a backstop to the Single Resolution Fund. We do have a discussion on another acronym, and here for the audience, CMDI, so Crisis Management Framework, that's currently under discussion in the Council and the European Parliament. That is basically a framework that tries to regulate, to harmonize the way that national deposit insurance funds can be used and the way that resolution frameworks and liquidation frameworks are applied. Now, absent of this, we do have some vulnerability, I understand, from your view is, Nicolas, and we do have had, in fact, cases of still applying national law, the Venetian banks, in fact, actually also Nord LB, which is a case which implicated the savings as well. So to a certain extent, I think there are arguments that go in the direction of saying that the second pillar is not yet complete. At the same time, there are voices that the discussion at the moment in the Council and the Parliament on harmonizing these frameworks are actually probably making the system even more complex. At least some critics say. So, what do you answer to that?
So I'm listening very well, and another topic crossed my mind, because I fully agree, Nicolas, that the thought of there will be another crisis coming. We had Corona, we had the US and Switzerland, and we don't know what will be there in the future. That is a big discussion currently in Europe and actually in the entire world. But the answer actually is then not completing or changing a banking union. So the answer is now given by the main authority itself, the EZB. And they say, because that might happen, we will build an entire new payment system and will interact with the clients directly. So when there is a bank struggling, when there is a bank run, whatever, then the client can go directly to the EZB. And that project is called the digital euro. So what I think is we can't discuss EDIS on the one side and at the same time the digital euro on the other side. And both interacts with the EZB. And the EZB is currently, by doing this project, changing their role of the European authority. They will interact like a bank, which will need KYC processes, and so on, and will change the business models we have. So everything together will not work. So I think the regulator should make up their mind what they want, and I think a digital euro in place would stop the discussion of EDIS immediately, because both together doesn't work. And because knowing this, because that is a discussion quite a few years ahead too, we, the saving banks, founded a European project to give a constructive answer to that and to keep Europe competitive, and that is called Vero. So we have a European payment system that is called Vero, that gives the EZB the answer they need, and that solves the discussion immediately in terms of the digital euro and EDIS, because both is not working. And when, imagine now, the digital euro would come as the project they have, then you can't include the EZB in EDIS itself. That would be a gigantic, I don't know what, a gigantic mess, I think, if that doesn't work together.
I'm not sure I understood why digital euro and European deposit insurance were incompatible, but let's leave that aside. I just want to clarify the position of the European Central Bank, and I speak under your control, Johannes, because you know them very well. The European Central Bank has been consistently, since 2012, since early 2012, in favor of a European deposit insurance and of what I describe as the completion of the banking union. They have consistently advocated doing in crisis management what has been done in supervision, even so they would not be in charge of that, by which I mean creating a European framework for crisis intervention as opposed to the current unstable mix of national and European. So just to clarify, the position, I'm independent from the ECB, I occasionally disagree with them, but on the policy prescription, what is suggested in my book and in what I just said is completely aligned with what the ECB is recommending.
I will only say one sentence on the digital euro, and I think I would see what Nicolas said has some grounding in the sense that the digital euro will probably have a cap on holding, and if that cap is around 3,000, it will not be one that is comparable to the 100,000 protected insurance on the deposits. But I have
to correct it, because the answer is they will start with 3,000, and then we will see. If there is a bank run, it's open up. There is no end.
But I think it's fantastic that you bring this up, because this is definitely something that we need to follow up in terms of another event.
It's another panel.
But we should do it. Should do this as another event. Now, but I want to concentrate a bit more on EDIS. Now, you said the saving banks have their own proprietary system that is working very well, and it should be fully recognized. Now, first of all, maybe if you could elaborate a little bit more what you mean by that. And secondly, now, from an economics perspective, now EDIS also has the advantage that it makes the European deposit fungible across member states, wherever you are. And to a certain extent, that's also a public good, namely that you ensure financial stability and fungibility of deposits for the Eurozone as a whole. Now, how would you, as saving banks, contribute to that public good? And maybe these two questions would be very helpful, because could there be something that would allow you to see that EDIS is in fact an improvement, and how would that be compatible, or you would want to be compatible if we were to go in that direction?
Yeah, that counts for all IPS. So we are protected in our, let's say, own system with our own members. So when there is a bank struggling in our system, we take care. We don't need BNP Paribas or UniCredit or Deutsche Bank for that. If Deutsche Bank has an issue, I think, for example, a saving bank will not help that in that issue. So that I think that are the two main things. But the thing is that I already said in my speech as well, we need both. So we need for the national champions, national banks that have their own system. So if there is a bank struggling, if there is a crisis or so, we help each other. And if you have international champions, then you need the international network. That is the same. So I think we need both, and therefore we need both systems. And for our national system, we pay to a fund as well. And if we have to now say, okay, you have to pay for international business and clients as well, then we would pay billions double. And at the same time, we don't do the international business. I tell you a concrete client, that is Birkenstock. Birkenstock was years ago a startup. You would nowadays call it a startup. It was financed by a saving bank. Then it got bigger, and then a Landesbank helped to get more financing on it. And then since a couple of years, it's now international, and now at the New York stock exchange. And then the saving bank step out and other banks step into that business. But that, if now something is happen in terms of that bank that is now engaged in that will need a network, and we have our own network. So that it all makes sense when you see the historical reason and what kind of clients and kind of risk and needs you have. And then the moment the clients get international, then an international bank is taking care, and that is in another network. The network, the international network, is nothing else than our national network. And I think if a international bank or doing international businesses will not need our system, but the other way around, we don't need the other risk in our system. So then you have another discussion, and you mix up risk and needs and businesses, and that is why it's not working.
So every bank, by its nature, will tell its clients and the public, we are very soundly managed, we are a low-risk organization, we will continue to be there forever, your money is safe with us. This is part of the business of banking. And I don't think banks can be criticized for making that claim. It's the normal claims that a bank makes to their clients. That doesn't mean that banks are safe. That doesn't mean that financial stability events will not create a need for the public sector to intervene to preserve financial stability after a bank has, for reasons that may be linked to its own management or linked to external factors, not been able to deliver on that promise of stability. And this has happened time and again in history. If you take a stroll through Mitte, you will see the former headquarters of many banks that have disappeared, some of them through mergers, others through distressed situations, in many cases both. I was walking on Französische Straße from the ESMT to come here, and I could count the former headquarters of Dresdner Bank, Berliner Handelsgesellschaft, from afar the Diskonto-Gesellschaft, Deutsche Bank, the former headquarters, and more, and Commerzbank, which is now DSGV. It's the former headquarters of Commerzbank, yes, absolutely. I was talking about the buildings. Yes, no, omens there. Why am I saying that? The German Sparkassenfinanzgruppe is a banking group, as its name in German suggests. It is true that these are local savings banks. They are managed in a very decentralized way. But the group, through the institutional protection scheme, through the IPS, guarantees them. And essentially, in terms of banking risk and systemic risk, this is a single organization. There are other organizations of the same nature in Europe. Generally, they are counted as one bank, typically cooperative banking groups. Think of Rabobank in the Netherlands, OP Group in Finland, Crédit Agricole or Crédit Mutuel in France, and so on and so forth, Cassa Centrale Banca or ICREA in Italy. I can give more examples. The specificity of the DSGV and of other institutional protection schemes is that they are organized as networks of banks, and from a legal perspective, each of these banks has a separate banking license. But again, economically, they're one banking group. The fact that this banking group has been around for, depending on how you count, probably something like 2 centuries, doesn't mean they won't fail. Because we have other examples of banks that have been around for a very long time, which end up, hitting a roadblock and necessitating public intervention. So it is incautious from a public policy perspective to say, because the Sparkassenfinanzgruppe has an institution protection scheme, they're not in need, they will never be in need of public intervention. And indeed, you have a number of groups that share some, maybe not all, but some characteristics with the Sparkassenfinanzgruppe. If you think of the French savings banks, if you think of the Cajas de Oro in Spain, if you think of a number of Casse di Risparmio in Italy, and I could mention more, that have necessitated public intervention and the use of public funds to bail them out or rescue them in a crisis. So the proposition that the Sparkassenfinanzgruppe is immune from that framework of financial stability and crisis intervention is not something that should inspire policymakers. And that's exactly why the Sparkassenfinanzgruppe should participate in a European deposit insurance. The reason why it doesn't currently participate in an overarching deposit insurance in Germany is linked to German history. I'm not going to elaborate on that. I'm not going even to criticize that. I will just say it's entirely a product of historical circumstances and not of organized thinking about how to ensure that German deposits are safe. In a European deposit insurance, there should be, of course, recognition of the features of the Sparkassenfinanzgruppe institutional protection scheme, and therefore that would have probably an impact, and a positive impact from your perspective, Karolin, on deposit insurance fees. So there is no reason that the fees that would be paid into a European deposit insurance should be equal for the Sparkassenfinanzgruppe as they are for, say, a local Italian bank, which is on its own, and therefore not benefiting from the institutional protections that the DSGV provides. Having said that, this should not be a reason for exemption. Not only would exemption be bad public policy, but it also, conversely, the fact that there is a European deposit insurance, of course, if it's well designed, is absolutely not a threat for the construct of the Sparkassenfinanzgruppe. The proof here is in other institutional financial protection schemes in Europe, and particularly in Austria. There was a moment, if you look, sorry to get lost in the details, when the Raiffeisen group in Austria, not the German Raiffeisen, but the Austrian Raiffeisen, which is also in institutional protection schemes, joined the Austrian national deposit insurance system, and that demonstrated that they could be under the German, the national deposit insurance. And for exactly the same reasons, they could be under a European deposit insurance system without disrupting their business models. And they decided to exit the national deposit insurance system again because they could. Whether that's good public policy, we can debate. But the demonstration was made that you don't need to change the way you operate as a beneficial system of local banks for the German economy, being in a European deposit insurance system, provided, of course, that it is well designed. Sorry to be a bit long on this, but I want to conclude with a bit of context. Karolin correctly said there are other institutional deposit insurance, institutional protection schemes in the EU. Well, Poland is aside because it's not in the Eurozone, but there are some in Austria, in Italy, and in Spain, not in the other member states. Having said that, I think it's important to remember how dominant the German IPSs are in that landscape, so that the Sparkassenfinanzgruppe and also the German Cooperative Financial Group, they represent the vast majority of IPS assets. I haven't check the calculation, but I would say something in the along the lines of 75 to 80 or maybe even more % of total assets of institutional protection schemes in Europe. So that's just Germany as a proportion of the Eurozone. And they represent alone the less significant institutions. The LSIs in the 2 German institutional protection schemes, I think, represent more than half of the total assets of all smaller banks, all LSIs in the Eurozone. So you're right, Karolin, that, you know, it's not special pleading, but together with your colleagues in the, Volksbanken and Raiffeisenbanken, you actually dominate that landscape.
Yes, you mentioned in the beginning a lot of names of banks that that disappeared. When I understood it correct, they were not banks that were in the German saving banks IPS. So
well, I didn't want to say bad things about the Landesbanks, but if you want to start that conversation, I think it would be actually relevant to what we're talking about.
But that was solved, I think, without any. We didn't want any European money for that.
A lot of German taxpayers' money, and then the question is in the Landesbanks. Look at WestLB. Remember WestLB. Look at what was done. Remember Sachsen-LB. Remember the risks that the German taxpayer took with LBBW, with Bayern LB, and you cover the vast majority of the Landesbank sector. You mentioned, NordLB. We didn't mention HSH Nordbank. In NordLB, the Commission, in an extraordinary assessment, said that the money provided by the German taxpayer was provided on commercial terms. I don't think anybody believes that. So there is an ample series of examples of that kind of bailout.
So you say mixing up the names you said 10 minutes ago and with the names you said now in the last minute, that will make a safe, smart, competitive Europe, mixing up all these institutions with all the risks. And then we have the same discussion with UniCredit and Commerzbank, where UniCredit says, but the German SMEs, we don't want. So who's taking care? BNP Paribas? Maybe we go to the US. Then we have, then I would say maybe we should first take a look in the tax payment system. And if you could first solve that, then you would have a very clear answer what the saving banks group is paying in terms of taxes. Germany without the saving banks, and I include the Genossenschaftsbanken as well, would have no schools, no sports activities, no Staatsoper, no Philharmonie, nothing like that. And we would give a lot of payment into UniCredit, solving a problem that is maybe eaten in a few years by the US. If that is a competitive Europe, go for it. But then, sorry, I want to protect my clients and I want to give them the best decision and fast decisions they need to open up a bakery.
I'm glad that the promise of a heated debate has now come true. So I think this is the moment when I would like to open up to the audience. I know we have friends from the cooperative banking sector here as well. Without kind of looking at people in the audience specifically, but I would like to nevertheless open up now. I think you've seen the different positions and your chance now. Have a number of questions in reserve myself, which I haven't covered yet, but I want to also give you the chance to step in. Yeah. Maybe. Yeah. No, we do have.
Thank you very much, cooperative banking sector. So if I'm so much invited to make a remark, of course, Nicolas. When you talk about, and I'm fully in line with Karolin here, obviously, as is to be expected. Indeed, when we talk about the expansion of CMDI, the crisis management. So first of all, I'd argue that there is a misunderstanding, even of the Commission side, if they distinguish between crisis management and deposit insurance. Because deposit insurance is a valid part of the crisis management. So there is a first failure in the distinction between these two. We now had a number of cases in all kind of member states. The last one, beginning of August in Luxembourg. Nobody will heard about it, most likely. That is because the system works so well that nobody cares about it. You are being repaid in 7 days' time. We had failures in the Netherlands, in Austria, a couple of number. So I think that it is not right to assume that you do need resolution for maintain confidence in the banking sector. Nobody cares because it's a very easy conveyable message. Your deposits are protected up to 100,000 euro per bank. That is something people do understand. On the other side, and we are working as practitioners in the crisis management regime, when people call, I'd have to tell them, okay, most likely your bank is going to be resolved, but we don't really know. And it's not us making the decision to use those funds or not, it's on a European level. It makes it overly complicated. And now the question for you here is, now taking into account the moral hazard, if you were to expand resolution to all credit institutions, even the smallest ones, like the intention of the European Commission seems to be, customers, in particular larger customers, would not have to take a closer look at their bank anymore because they would have faith in their deposits being transferred to another credit institution. We have seen that in Silicon Valley. Nobody really cares in the US about $250,000 protection ceiling because they are faithful, their deposits will be transferred. And that is exactly what happened in February. So here, if we say we expand the resolution to all banks, I'd say and argue the likelihood of additional failures that would have not occurred if you expand the resolution would increase because people do not pay as much attention where they put their deposits as they should. And that is why exactly even from an IPS, so institutional protection point of view, the insolvency is the standard market exit strategy for a bank, unless it is cross-border operating, unless it is of a high level of significance for the market entirely. So IPSs are a safe layer in addition to that. But even if the IPS were to fail, I'd still say then it would rather be insolvency resolution when it comes to a smaller bank. So what do you think about the moral hazard that would be applicable if you say resolutions for all? So don't really take a look at the business model, just be interested in the interest rates and spend your money because you will be safeguarded by the transfer of money to another bank.
Okay, so there is a lot to unpack there, and thank you very much for the question. It raises a number of the key issues. I will try to reformulate what I understood to be your question. And I think it revolves around two main issues. One is a fundamental critique of deposit insurance as creating moral hazard, and this critique has been there in the debate about deposit insurance since as long as deposit insurance has existed. And actually, I think the first organized system of protecting deposits was the German cooperative banks back in 1934 or 35. So this is the system you created.
It's fine for up to 100,000. That's the trade-off. They do accept moral hazard up to 100,000, but beyond that, you don't.
But here you're not talking for yourself because German cooperative banks, like the Sparkassen, actually protect the entirety of deposits and actually of full liability. So that's why the scheme is called an institutional protection scheme. So basically what you're arguing here is you're intruding into a debate about how to deal with banks outside of your institutional protection schemes, but this is not something from which, if I can put it that way, you have insider knowledge, because this is not a relevant question for the German cooperative banks because they are under an institutional protection scheme. And this debate about the moral hazard embedded in deposit insurance is actually not only about the threshold, which in European law is set at 100,000 euros, it's about the notion of deposit insurance itself. And in a way, there is no good threshold to resolve that debate. So the choice that most jurisdictions have made is to try to square the circle by establishing a deposit insurance but capping it at a certain level. This is an imperfect compromise between different considerations. The people who say that any deposit insurance creates moral hazard have a point. The people who say that deposits need protection have a point. These systems of capped deposit insurance are a compromise between these two concerns. I think ample experience in the last century or so has demonstrated that such a system makes sense, that it's a good thing to have deposit insurance, it's good for financial stability, it's good for monetary stability, and also that it's a good thing not to have unlimited deposit insurance because otherwise moral hazard would have detrimental effects. So the general choice, and sorry to be a bit long on this, to have a deposit insurance which is capped, I think is reasonable, and then the question is about the modalities, the level of the threshold, and things like that. You introduced a second debate, which is really for very arcane and for the nerds. This is the debate of insolvency versus resolution, which, by the way, is a vocabulary that nobody can understand outside of Europe because that distinction only exists in EU law. I don't want to enter too much into the technicalities of that debate. I will only say that your proposition that resolution is for the few, not for the many, as Elke Koenig, the former head of the Single Resolution Board in the past, had famously or notoriously put it, is highly questionable from a policy perspective. Let me put it that way. And I will take two examples to illustrate the point I'm making. One is the United States, the other is Denmark. In both those jurisdictions, basically what you have is a resolution procedure, I use the word in the European acceptance, being applied to all banks no matter how small. And it works pretty well. In the US, there is a lot of track record for that system. I can elaborate and explain why what happened last year with Silicon Valley Bank doesn't negate what I just said. And in Denmark, it's much more limited. There have been basically 4 cases in the last 10 years, so it's too small a sample to draw major conclusions. But still, those 4 cases are significant because here are 4 banks for which not only was resolution used and all creditors wiped out, but actually uninsured depositors lost money in those cases, but the system held and there was no need for exceptional intervention. And the Danish authorities argue that this is because they had done their job of explaining not just after the fact, but also before the fact, how the system would work. So again, I don't want to be lost in technical details, but I think the argument you made for banks other than those in institutional protection schemes, that the small banks should not go into resolutions, that is something I would refute very strongly.
Okay. Now turning back to Karolin from what Nicolas said, and maybe also from my side, I unpack it because I see my role not only as a facilitator between the two of you, but also to maybe unpack for some of the students here that maybe not all connoisseurs of banking history. And I think if I understand correctly what you said, Karolin, and to a certain extent also the point that was now made from the cooperative banking sector, we have a system that works well for us. We are active mainly in the region. So it works for us, we're active in the region, we don't want to go cross-border, so why do we have to change? Now, the question that I think is essential is, to what extent has the decision in June 2012 changed fundamentally the framework? Meaning, we decided to enter a banking union. Which means, and here we are with Nicolas, you are now part of a bigger framework, which is the banking union. That means you can make the case that your system works, and that's why the contribution to the overall system is one that would probably be much less. It's a bit like within a small farm in a town where you say, we are so far apart from the main town, our contribution to the fire protection is very limited because most fires we do alone. But still, the town will tell you, you're part of the town. You have to pay to the fire insurance. Why are you not part of the town?
We are very part of the town. And I want just to give you maybe to look forward. What is the EU doing? They changed the name from Capital Market Union to Saving and Investing Union. Because transformation, and that is the main issue for the next 50 years, $800 billion every year. That is what we have to do. We have to transform private households, companies, and the country entirely. And that Europe is telling us, or Brussels is telling us, that just works with the people in the regions. And so this is, the focus is entirely on the saving banks and on the cooperative banks, because we are with the people and in the region to do the transformation. And this is why we are a big part of Europe, of the banking union, and we have 50% of the name of Europe in our name. The savings union, the saving banks. I think we can't do much more integration than that.
Obviously, I have a lot of sympathy with the way you just framed it, Johannes. And the point being, but I would take it one step further. I think the reason why the savings banks are part of the town, cannot be isolated from the general consideration of financial stability, is not just because the banking union was created 10, 12 years ago. It's because we share the same currency, and banks participate in the system that creates and manages currency. So the reason why deposit insurance is not just about financial stability. Deposit insurance is about the currency itself. It's about trust in the currency. And if the currency is not trusted, then you have a major issue of social trust more generally. So essentially, I would make the argument you sketched, but push it one step further. Because they are banks, because they participate in the creation of money, the savings banks cannot be viewed in isolation. They are part of the system.
Exactly, and you said the trust in the currency. The EZB is calling that a digital euro. I'm back to that. That question is really solved. And the other question, we are part of that. And then you have to name it the ring fencing. It's not about EDIS. It's about that you have to, or you want to do a ring fencing, and you have to turn subsidiaries into branches. That is what you have to talk about because EDIS is talking about European mergers. We saw it, Commerzbank and UniCredit. You don't need EDIS, but you have to talk about ring fencing. If we do that discussion, then very welcome. But then we should do a discussion, ring fencing with the digital euro. And then we are, I think, the European Union in 2045 to have the CO2 down, and we have ring fencing solved, and we have a digital euro, and then we have a really perfect banking union. But I'm very afraid we will not have a lot of customers left, because with all this discussion and unsolved tax regimes, they will go to the US and do the business there, because there they can do it very easy, very, very smart, and just online within 5 minutes. And that is the main issue. We have to take care about the people in Europe. If we don't do that, we will lose whatever or however we will call it.
I want to give the audience one last time to ask a question, and I would collect them. So this is your chance before concluding. So I have 2 questions. Anyone else? And then we collect these 2 questions. Please.
Thank you. My name is Willem Noé, European Commission, DG ECFIN, also a number of other DGs. My question is on the following. I'm missing a bit, or maybe I shouldn't, but I'm missing a bit the discussion on the capital markets union, because to my mind, they're very closely linked, and the banking union is just a very small part. Well, not a small part, it's a big part, especially for Europe. But the capital markets union, so my question is the following. To what extent do you think they're also linked, and to what extent is progress in one means less progress in the other, mainly maybe for political reasons? Thank you.
Please.
Something completely different. I hope it fits in nevertheless. So the current banking supervision and regulatory framework is basically mainly based on credit risk, not so much on climate risk. And seeing that climate risk may represent a systemic threat to the banking sector and is linked to losses in the financial system. And going back to Draghi's report, and we are a union, we have green laws and green finance and everything. And in reference to the book, of course, about next steps, what should be done in terms of macro and microprudential policies to complement supervisory measures in this regard?
2 very good questions. I mean, possibly we keep the question on the green relatively short, because I understand that the supervisory framework is now trying to include, in fact, quite a bit stress testing on climate, as well as including some of the kind of preparations that banks have to do for in terms of climate change. But I mean, feel free to go to both questions. And indeed, Capital Markets Union is something that it's very good that you bring it up, because we wanted to cover this as well. So both excellent questions, but I give the floor
to both of you.
Yeah, maybe I start because thank you for the question. And that is the question we always have. So all countries, all banks, all saving banks are agreeing to the capital market union, and especially now where it's called saving and investing union, to change Europe to a competitive country. And we want to get this really done. And we also had a discussion about CMDI. So this is why we, as the Deutsche Kreditwirtschaft, not only the saving banks, so all of the banks in Germany, wrote a letter to the Commission to say, look, first do the capital market union done, work on CMDI, and then we will see how we end up, because both will affect the EDIS discussion we have. And I think when we start that, then we will solve whatever there is missing anyway. And that leads to the questions about the green, because we have to do it in parallel. We have to change to the capital market union to get this done, and also to get what is Brussels calling the Green Deal. So do the transformation of the country as well, with all the measurements you have, and that is in place too. And we're really going forward to it, and we do a lot of things, and everything is connected. So I would focus on what is important and what is needed and what unites every country in Europe and every bank and every saving banks. And that will lead to another discussion in terms of EDIS. I'm pretty sure of that, because it will solve different discussions we already have, and then maybe in the end we will see that what we called EDIS is no longer needed. What we maybe need is the tax regime in Europe, because as long as this is not in place and so different, that is maybe the main work we have to do. But let's go for that, and I'm very glad that you had this question.
Nicolas.
Yeah, on the climate piece, Johannes gave the answer. It's not really a question of supervisory structures or even regulation. The system is in place. It's about supervision. It's about understanding risk in a holistic way. The European Central Bank, and more generally the system of European banking supervision, has been at the forefront of that. I think there is no other supervisory system anywhere in the world, at least in significant jurisdictions, that has devoted as much attention to climate risk as the ECB and the European banking supervision have in the last few years, and they're continuing to do that, do climate stress tests and the like. So I would say, for your concern about integrating climate, the fight for against climate change into financial services policy, the European banking supervision framework does provide the response to that concern, both in theory because it's the right level of supervision, but also in practice because they're actually doing it. Whether it's sufficient to tackle the climate challenge, my answer would be no, because I don't think you can tackle the climate challenge solely out of prudential supervisory concerns, but that's why we need, a carbon tax. On the other question about capital markets union and banking union, I think I'm not particularly worried about the semantics, whether it's capital markets union, savings, investment. I'm more concerned about the actual policies that is embedded in that project. And I think the honest observation tells us that in the last 10 years, so during the Juncker Commission and the first von der Leyen Commission, in parallel with the fact that there has been not much progress on the legislative front to complete the banking union, the capital markets union project, if we have to call it that way, has been long on rhetoric but very short on policy. So it would be an exaggeration to say nothing has happened, but not much has happened. I think the challenge for policymakers, emphasized by both Letta and Draghi and many others, is to make it real. To do something concrete that would advance this vision of an integrated financial sector. I think from that perspective, if I understand the semantics of savings and investment unions, they bring together what was previously considered under banking union and capital markets union. I welcome that in principle. I think the question is, what are you doing to make a difference? And I think here you basically have two major projects, two major policy propositions. that reside within the framework of financial services policy. One is the completion of the banking union, as we discussed it at length. The other one is to create an integrated supervisory framework for European capital markets, a bit in parallel with what was done for banking in that major decision in 2012 that was implemented in 2014. So that's about capital market supervisory integration. It basically means in practice taking the current agencies that is called the European Securities and Markets Authority, completely rebuild it from the ground, because at this point it has not been designed to be a supervisor, making it into an effective supervisor, which requires profound reform of governance, funding, etc., and then give it, maybe in a gradual sequence, a mandate to supervise European capital markets. This would not be enough to create an integrated European financial sector, but I think it would be transformational in a similar way as European banking supervision has been transformational for banking. Will that happen? Time will tell, but I think this is by no means, these two projects, completing the banking union, creating an integrated capital market supervision, what Christine Lagarde called the European SEC, they're not competing projects. They would support each other. And the same way as the proof of concept that is European banking supervision that has been up and running for 10 years and works, has encouraged the creation first of an AML supervisory authority that deserves more attention, and that is now being created in Frankfurt on the basis of legislation that was published in June. And I hope in the future a genuine capital market supervisor. So the fact that we have the banking union makes this proposition of capital market supervisory integration much more palatable, much more realistic, much less difficult politically. It is difficult, but it is much less difficult than it was 20 years ago. And conversely, the creation of an integrated capital market supervisor would support the completion of banking union.
So we've also at the end of this discussion covered another topic which probably warrants another event here as well on capital markets union. So in terms of homeworks, we have to cover the digital euro and the capital markets union, although I can recommend watching a panel we had in May on that topic in Paris, but not here not here in Brussels yet. In Berlin yet here at the Hertie School. Now I'm confused with all the different capitals. Just to conclude, I'm grateful because I think I have two very strong advocates for their position. I had not assumed that we would completely converge, but I was looking forward to strong arguments. And I have to say, Karolin, you brought your perspective very passionate and strongly forward, and Nicolas, I had not expected anything less. So let me say thank you very much. I promise in 10 years' time, when you write the 20 years of banking union, we do it together, or maybe the two of you author that together. That's a promise that I'm happy to take up. So to be continued, thank you very much for coming. Thank you for everyone online. And I wish you a great afternoon and a good Feiertag tomorrow. So all the best.